Just kick things off, I would like all of our wonderful panelists on stage to introduce themselves. So maybe you could say a couple of words about yourself, your company, and your interaction with tokenization in the space.
Sure. Hi, everyone. My name is Antoni Trenchev. I am the managing partner and co-founder of Nexo. We are a financial institution which provides banking services to the blockchain space. Tokenization is incredibly important to us because it quite simply brings the total addressable market from the billions into the trillions, and the potential to disrupt just about any aspect of how we conduct business and how we unlock the value of all assets is incredible, and really happy to be here and talking about it.
Thank you.
Hello, everyone. My name is Dotun, Rominiyi. I'm here representing the London Stock Exchange Group. I'm sure most of you are fairly familiar with the organization. We have been doing a lot of exploration around digital assets, namely digital securities. And our focus is really on kind of our bread and butter. You know, we are deeply invested in capital formation and providing capital liquidity to the financial service industry, and so we believe that digital assets represents a key and fundamental part of the future of that landscape.
Okay, thank you. And thank you for speaking over the audio. I'm sure we're doing great.
Yeah. Pietro Grassano, Algorand. We are an open source, permissionless blockchain protocol that aims to represent the infrastructure for the next generation of financial products.
Hi, I'm David Abner. I run a boutique advisory focused on ETFs and digital assets. Just a short history, I came out of the ETF world. About 2 years ago, I was running WisdomTree Europe, and we started working on a strategy around digital assets because based on the belief that if you're in the asset management industry, over the next 5 years, you're gonna need to execute on a digital asset strategy. So we started working on things like Bitcoin ETPs and thinking about tokenization and things like that. So I left WisdomTree in July to focus on this advisory piece. But over that time period, over that time period, the last 6 months or so, we've continued on that strategy with WisdomTree. So they've launched a Bitcoin ETP in Switzerland. It's actually the first ETP to break the sub 100 basis points barrier in terms of pricing. We have made an investment in a tokenization firm in the US called Securrency, and we've started working on stablecoin and tokenized ETFs for the US market. In addition, I joined a gentleman named Rick Edelman in the US focused on advisor education of digital assets, with the belief being that we all here can build it, but if we don't educate people on how to use them and how to access them, they are not going to come. So 2 weeks ago, we spent some days in some conferences at the TD Advisor Conference and the Inside ETFs Conference. We spoke to about 1,000 advisors on digital assets and started the beginning conversations on how they can utilize these tools in their portfolios. Thanks.
Thanks, David. Thanks, all. So to kick this off, maybe let's start just a little bit high level. Who in the room has heard the phrase tokenization? Raise your hand. All right, good. Who is 100% confident that they know what that means? Less people. All right, cool. Some of our panelists. Oh, God. All right, this will be fun. So maybe whoever's feeling brave on the panel, if you could just explain what tokenization is at a high level and why it's important.
Who volunteers?
No volunteers?
No volunteers.
Okay, well, I'll volunteer then. Well, tokenization is a very simple concept. It's the execution that's the tricky part. It's the idea of bringing assets, real-world assets, such as stocks, bonds, but also real estate, fine art, vintage wine, into the blockchain space and bring them on-chain so that they can be owned, exchanged, traded, borrowed against in an efficient manner, just like we would do with any digital assets such as Bitcoin, ETH, XRP, whatever. And yeah, that's pretty much it, I guess.
All right.
Can I add a piece about why I think it's important?
Please.
So I think it's an infrastructure play more than anything else. I mean, yeah, we're going to have a lot of conversations about bringing new asset classes, accessing real estate, things like that. But I think if you think about it from an asset management lens, which I think a lot of people in this room are going to have, it's about continuing to drive efficiencies in the way asset management serves clients, right? So if you look at where assets go right now and what the world looks like, the world is moving towards lower and lower, if not zero fee products to manage portfolios of assets. And in order to facilitate those lower fee products, you need a leaner and leaner infrastructure. You need to speed up clearing. You need to remove administrators and things like that. I think that's what tokenization is all about.
I think I would echo David's sentiments. I think when we look at kind of the broad landscape of capital markets, specifically from kind of our purview being a financial markets infrastructure provider, what we see is a space essentially that's very fragmented. There are lots of very large institutions that are involved in various activities across the entire kind of end-to-end life cycle of the kind of securities and asset kind of value chain. And what we see are activities that create data that get input from in a system that's controlled by an entity, and then that gets passed through manual means to other entities, and then that's kind of how information is propagated and how the representation of assets exists today. What we see through tokenization essentially is a form of automation, but kind of cross-organizational and full value chain automation, in the sense that you create a landscape whereby the assets are natively represented digitally and can flow digitally across the ecosystem, allowing all of the various participants to be able to interact with those assets and the data associated with those assets from a single kind of source of truth.
Got it.
Can we go for a very simple definition? Which
I would love it.
Tokenization is the representation of a value through a token.
There you go.
Right?
All right. We should have started with you.
Are you allowed to,
Worked our way down.
use the word token in your definition of tokenization, or does that break some sort of rule?
Through a something that is called token. Right?
All right.
We're loose on the rules.
And then, interestingly enough, the problem that we all have, I think, and I'm quite new to the industry, so if you want, I can give you a fresh perspective on it, is that we struggle separating the native tokens, the asset-backed tokens, the coins that are native to the chain, right? Because at the end of the day, there is this sort of difficulty in separating the protocol from the asset, the infrastructure that is actually the thing that makes the whole concept of tokenization so interesting, because it has so many benefits. Benefits that are linked to less cost, as you mentioned, less friction, that are linked to traceability, which is a hugely important element in the financial industry. The lack of traceability is one of the causes of the shape and form that 0708 took. And then, of course, the ability to give liquidity to asset classes that do not necessarily have this liquidity. On this, we can go a bit more in detail. But at the end of the day, it's the protocol that represents the asset that is the infrastructure.
Got it.
Stick to that.
So tokenization is a new way of representing value in a digital way. And there are all of these benefits that are associated with it. Again, whoever's feeling brave, could you help connect some of those benefits, Pietro, that you were just talking about, to this new way of representing value? Why representing value in this new wrapper do you get things like decreased costs, liquidity, et cetera? What's the connection?
The connection is, I mean, for market practitioners, it's pretty simple. I mean, you have the possibility through a tokenized asset to transact in a much smoother way. You have the ability, for instance, there is an interesting paper that came out from your competitor Deutsche Börse that is not here now, talking about collateral management through tokens. Can you imagine the old collateral management industry able to avoid passing through custodians, having simultaneous settlement of the movements? Would be a very different kind of logic in terms of how much cost, coming back to your
I like where you're going.
Logic, from what is happening today, right? You don't have reconciliations. You don't have a mass of intermediaries that often are related to a technology that was innovative 30 years ago and today is obsolete. This when it comes to costs. When it comes to traceability, there are interesting use cases like the one of our partners, Stone Eyes, that by the way is in the room, that do securitization of account receivables on the chain, pari passu with the documentation they have to provide off the chain. They integrate the whole value chain between the originator, the SPV, and the investor in a perfectly traceable manner. So you arrive as an investor to understand, to split the different layers of invoices in the account receivables that represent the SPV. In that way, you have a perfect traceability. You can make conscious risk management and investment decisions in a way that was impossible beforehand. And then liquidity, of course, you can have a different way to pool together different assets. You can have a way to fraction the assets in a much finer way than before. You have less obstacle to the entrance. I think that, well, personally, I believe that liquidity pools decide where they want to go, and the market follows the liquidity pools and not vice versa. So I'm not 100% sure that, okay, let's tokenize a Picasso painting is going to be the best thing to do. But for instance, for real estate, some of these frictions that are related to the common way to transact on real estate, once you have a better way to transact on real estate, they will lead to a larger liquidity pool going in that direction.
So just 2 comments to make on that. So I 100% agree with all of your comments around some of the benefits of tokenization. I think when we look at the kind of sphere of the security space, I think a lot of the kind of benefits are specific to certain asset classes. And sometimes we talk about tokenization, we talk about digital securities, but really, what are we talking about? We're talking about a digital representation of a legal construct. And so really it depends on what that legal construct is. The benefits of a digital ETF will be very different to the benefits of a digital debt instrument, for example. So if we look at, for example, the European corporate debt markets, a lot of the kind of commercial activities that we see in the primary space, but also in the OTC space, are still very, very manual. There's not a lot of kind of digital transformation that's happened over the years. That is starting to change now, and we're seeing a lot of interest in leveraging technologies like blockchain as a means to kind of pull that together and really streamline a lot of those activities. So there's a very clear and evident cost and time saving from that perspective. However, if you look at kind of UK equities or European equities, specifically when we look at the secondary market space, all of those assets are inherently digital today, right? So they're all fully dematerialized at central securities depositories. So there's not a great deal of efficiencies we can see there, but what we can see in some instances is an opportunity really to lay, let's say, a foundation for representation of these assets, coming through from a primary markets issuance, of which there are definite savings that can be made there and benefits to issuers and to investors. But then once you have the infrastructure that underpins these assets, that allows that streamlined kind of connectivity end to end, it broadens opportunities across the ecosystem. So things like automation of corporate governance, stock splits, asset servicing, coupon distribution, dividend distribution, etc., can all be automated and in a way that allows global distribution in real time, which provides some really interesting opportunities.
Absolutely. So there are all these benefits, right, to tokenization, right? There's decreasing costs, increasing automation, more liquidity for assets that are potentially not as liquid right now. But this is something maybe some of us in the room have heard before, right? Maybe people have heard phrases like tokenize the world and every asset is going to be tokenized. People have been saying that for a couple of years, but still we haven't seen much traction. So anyone on the panel, do we have comments on what are some of the roadblocks or hangups?
Yeah, I think it, again, it depends on what you're talking about. If you're looking at securities, I mean, obviously, the elephant in the room is obviously, regulation. And we can't blockchain our way out of the regulatory obligations that exist today, right? So an equity is an equity, whether it's represented as a certificate or as an ERC20 token on Ethereum. And so fundamentally, there are requirements that those assets fall under. So that be that MiFID, be that CSDR, be that the Prospectus Directive, the Settlement Finality Directive. There are a whole host of regulatory regimes, both in the UK, across Europe, and most of the world, most of which are kind of commonalized specifically around securities and rolled up under the PFMI regimes. And so we need to be kind of cognizant of that. And I think what we're seeing across the landscape is a lot of exploration in terms of trying to solve for creating infrastructure that is compliant to these regimes, but it does slow down the pace of innovation to what you would see in maybe other less regulated spheres.
I think investors aren't actually ready for the discussions that we're having a lot of, right? So looking around, I'm probably one of the older guys in the room. In the 1990s, I was investing in virtual reality stocks because I read a book called Neuromancer, and I thought that was the future. Okay, and I obviously lost all my money in the 90s on virtual reality stocks, right? We just weren't there, right? Now we're there. I think you have a lot of, yes, we will see all securities tokenized, right? They will run on a digital backbone, but they can't be used until investors can get there, right? The infrastructure for the way that investors access the market, the way their own trades are cleared and custodied and things like that. There's a huge on-ramp, right? And then beyond that on-ramp being in place, money has inertia. So for investors to sell one product that they already have and actually make a move into a securitized product will take time, right? It will take market crashes. That's usually when people change positions. It will take turmoil over sort of 10 to 20 years before we get to a point where we have real investor adoption on a lot of this stuff.
I have one word for you, and this is user-friendliness. The blockchain industry is still very nascent, and it's just the whole infrastructure. And we, the panelists, and some of the guys in this room, we live in our own bubble where we see the blockchain value proposition, etc. But that's not necessarily true of the wider, of the real world, if you would. So, progress is a slow process, and obviously we want to get excited, and everything has to happen in the next 2, 3, 5 years. It's obviously going to take much longer than that because people are used to doing things in certain ways, and until the companies that build the infrastructure and the products realize that you gotta give the same ease of use that they're used to with just about any other product, we'll not see large-scale adoption.
So how do you all reconcile this idea that we just heard Danny Masters talk about what we're building here is an alternative capital market structure? But what you were all saying is that no investors are going to move on this because it doesn't fit in with their current infrastructure, right? So how do you reconcile the idea that what we're building here is a more efficient infrastructure to represent value, and we're sort of shaping that and molding that to be appealing to old preferences and the old infrastructure that doesn't work as well? So how do you design a product to satisfy both needs?
It's for him?
It's for anyone.
Go ahead, Pietro, you want to hear?
But no, maybe it's also an answer to this question, but it was more related to the previous one. It's just a reflection. Why is there a sort of deception between the promise and the delivery, right? There is a gap. And I think it's simply because the technology wasn't there. I think that the logic that I keep on following, again, the protocol is the asset. The infrastructure is the real asset at the end of the day. Had to be refined, had to be brought to the level of the original promise. So how can you have the same user-friendliness, as you mentioned, or reconcile the existing way of working with the future one without truly atomic swaps, without instant finality of transactions? If I have to wait 10 minutes before my transaction is finalized, I'm not going to invest in the same way as before. I will not have the same kind of user-friendliness. I will not have necessarily the benefits of costs that I was thinking of. So that gap between theory and practice has to be bridged through the technology.
I think David also touched upon a very good point, and we got to bear in mind how Bitcoin came to be in the first place. It was out of the ashes of the financial crisis. So one of the bigger drivers of adoption of a new and a better technology is a crash. I think you said something to that accord. And this is also like one of the value proposition of tokenization that we talked about is like, how does any financial crisis come about? It basically comes down to lack of trust, right? And I think tokenization can do, the blockchain infrastructure and technology can solve a lot of those problems with instant settlements, distributed ledgers, and immutable ones. So, it probably is going, real life and mass scale adoption going to come out of some sort of crisis.
Just to kind of get back to the core of the question, so if essentially we're looking at why is it this kind of disparity between this view of, hey, we're building this new alternative financial system versus the old way of doing things, and are we just kind of bringing in a new technology? I mean, I would say that, to my mind, I see the benefits of tokenization as being a kind of a gradual evolution of financial services or kind of the broader industry. And actually we see that across many different sector verticals. If you look at some of the other kind of industrial sectors where we're seeing a broad scale adoption of not necessarily tokenization, but blockchain specifically as a tool for kind of end-to-end value chain optimization. It's a very, very good technology for solving some of these types of problems. And I think some of the interesting aspects of the financial service industry is we do have representations of value that we do have to interact with and we have to transfer and we have to manage. And I think blockchain, again, creates a really interesting and unique opportunity to bridge that. But again, we can't get away from the fact that we are a heavily regulated industry, one of the most regulated industries in the world. And I think without bringing kind of that understanding that is growing in the regulatory sphere, as well as kind of the innovators and everyone together to really drive that, we're not going to see any different. And if you look at the kind of crypto space and how that's developing and evolving, you've obviously got the DeFi movement, which is kind of trying to kind of emerge and grow organically, and we will see some growth there, I think, as well. And there's also the institutional adoption of cryptocurrencies, and we're seeing a lot more kind of growth and demand in that sphere. But I think ultimately where the real interest and value is from our side is definitely in the kind of institutionalization of tokenization for digital assets being securities and securitized instruments.
I think we're also not saying so much different than what Danny was saying, right? I think Danny's saying he sees the beginnings of an industry and that he actually thinks that a lot of the legacy players that haven't been involved are going to be coming in, right? So he mentioned Fidelity on the custody side. It wouldn't be surprising to me at some point to see Schwab buy somebody like Coinbase or something like that, right? As these two, what I see as two financial infrastructures start to come together, right? You're going to see a lot of, right now we probably have, 5 or 7 digital exchanges represented in the room, right? And then we've got the LSE here and their strategy around what they're going to be doing, right? These things are all going to come together and that will help the digital, the sort of the crossover and the on-ramping for customers, right? Because you can build a lot of new things, but in order to get those customers and help them translate from their legacy or their fiat infrastructure into this, you're going to need a lot of that cross-sectional work done first.
So what do you see that being for tokenization? So to use an example from your past life, right? ETFs versus mutual funds. It was in many ways a better wrapper, right? That, like, among other things, it's more liquid, it's more tax efficient. So that drew people slowly, and the migration is still happening from mutual funds into ETFs, which still hasn't all the way happened yet. What are those benefits for tokenization going to be, or what is your guess? Do you think that's going to entice investors?
So it's incredibly slowly, right? Like I look at my own experience, it was 2000 when I sold all my mutual funds and I said, I'm definitely only going to invest in ETFs for the future, right? 20 years and we're still educating investors, advisors who manage billions of dollars about the benefits of ETFs versus their legacy mutual fund holdings, right? So it's this is why I say money has inertia, incredibly slow process. People have more career risk by making changes to adopt to these new structures, no matter how clear the evidence is that this is better or more efficient, right? Which is why I think it's going to happen on the back end first. As much as we think that people will be clamoring for, partial investments in buildings, right? I want apartment 12C of that building, right? People can't even manage the portfolios they have now. So that, forget it, right? Until we've developed new portfolio management systems, people aren't going to be heavily investing in partial share buildings, I think, right? It'll remain at a high level institutional piece. But we have to build a whole new class of portfolio management tools to handle hundreds of different assets before we can even get there, right? So there's a tremendous amount of infrastructure that still needs to be built, even though we've been building on pieces of that infrastructure for almost 10 years already.
We need somebody to do for ETFs, we need somebody to do for tokenization what Warren Buffett did for ETFs, saying that once he dies, he's going to put 90% of his money into ETFs. That might drive mass adoption.
Instead, they're going the other way, right? He's
right?
like, those things are still, cancer or whatever he's calling them now.
Was the term for it. Yeah. So, what is the one question that I might be having if I were sitting in the audience right now is that we heard Danny talk about his experience in commodities and the financialization of commodities, right? So there's something that currently exists called securitization, right? Which sounds at a high level an awful lot like tokenization. So what are the core differences here? And are there assets that it does make sense to securitize, but not to tokenize, or the other way around?
I think if you're talking about any token that represents a physical asset, then by definition, there's an expectation that securitization is inherent in that process. I mean, tokenization it's a technological concept, right? Whereas securitization, again, is a legal concept. And so we always need to separate out our understanding of these two spheres. There's the legal sphere of like, what is this thing actually? What am I actually buying? What are my rights? What are my obligations? What do I do if I'm trading with a counterparty and they take my money and run away? What legal recourse do I have? What jurisdiction am I purchasing these things? What is the tax treatment? And then on the other side, you have the technological sphere or the kind of infrastructure and mechanical sphere of what is underpinning this? How do I receive my assets or deliver that asset? Or how do I transfer that asset to another party and how do I move that around? And whether it's physical or digital is a function of tokenization, right? But then on the same side, securitization, it provides all of the kind of legal structuring around how you immobilize that asset, again, if it's physical, to ensure it can't move underneath the token, and then all of the kind of legal certainty that's required in order to provide safety for investors.
I think that ownership piece is exactly the piece that's still hard for people to understand. So with gold, right, you can understand if you look at the ETPs, that the ETP allocates the shares you hold to a piece of gold bar that's held in a storage vault in wherever, in Switzerland or wherever that gold is, sometimes here in London. And Danny was talking about tokenizing gold. So you'll be able to do the same thing, right? You'll be able to see the token that you have that's represented to you and what that gold representation is, right? I think with a lot of these new asset classes that we're talking about securitizing or tokenizing, it's still very intangible for people to have even a legal understanding of exactly what they can access with that. And that's also why adoption is going to be slower.
So how much of the struggle here is actually a technological barrier versus maybe just a more traditional markets barrier, right? So one thing that gets said a lot is that, hey, we're going to tokenize all these mostly private assets, maybe that were larger, and we're going to fractionalize ownership, so it's going to be extremely liquid. But some people from more traditional financial backgrounds might say that liquidity is not a passive process, it's a highly active process. So there's the whole technology piece, and then there's the markets piece, both of which are barriers to adoption. Which is more of an issue? Or could you separate those two at least?
Listen, I think that actually there is a limit to the logic of tokenizing illiquid assets will make them liquid, which is from the portfolio management standpoint, the fact that often you want to invest in a liquid asset class because it has an illiquidity premium. What happens to that illiquidity premium if you liquefy it? Okay? Is it going to fade? Fine. Then why should I play that game in the first place? Right? And this is a kind of consideration.
So that's their source of alpha, you're saying?
Yeah, as a source of alpha. The liquidity premium as a source of alpha, right? And so while I see the point in tokenizing illiquid asset classes in order to avoid some of the frictions that are intrinsic in their own processes. I don't think that making them available on a purely liquid way to retail investors is going to be per se a game changer, right? So fine for institutional clients and so on and so forth. I think regulators think in that same way.
I think, again, I think it's also a little bit of a leap to assume that just because you tokenize something, it's going to instantly provide liquidity, right?
No, it's not.
I mean, ultimately, liquidity is provided by markets, and you still need to have buyers of the asset on one side and sellers of the asset on the other. And I think fundamentally, regardless of how much you fractionalize your asset or unitize it, like, ultimately, you still need to have demand on either side. And so I think when we talk about liquidity and providing liquidity, it's really around enabling liquidity in assets where there is demand, but maybe there are some frictions, as has been mentioned already in the panel, that are maybe preventing, let's say, the velocity of change of ownership of those assets. So, for example, like real estate and infrastructure.
And by the way, from a macro standpoint, if there is one thing that we are not short of in the last 10 years, is liquidity, right?
So, well, with regards to tokenization, one could argue, though, that it would bring in liquidity from players that until now had no means of accessing our traditional financial markets whatsoever. And I think that's one of the terribly exciting aspects of tokenization, is precisely having this low barrier to access to some of the asset classes. They might be illiquid for a while, but just having, like, I don't know, the African continent, being able to participate into Western-like wealth creation, redistribution, and investments via the blockchain infrastructure, that is phenomenal on its own right. Because these people they don't have the Charles Schwabs and the Fidelity accounts and the Bank of Americas and whatever, but there's still a lot of funds over there that could potentially be soaked into the whole infrastructure of more traditional assets via tokenization, and that is a game changer to me.
I think maybe to slightly play devil's advocate, I think the perspective that tokenization provides democratization of access, I think is an interesting one. I think in some cases it can, but I think, again, let's remember, with a lot of assets that we see today, ownership of an asset is a very it's very deeply tied to the kind of sovereign and governance structures of your kind of nation state and your country. So, for example, in the UK, there was a paper put out recently by the UK JT, I believe it was, around the legal ownership of crypto assets and smart contracts. And one of the key points made in there was essentially a recognition of crypto assets as property, legally as property, right? So unless there's a recognition that within the local laws and legal regimes and regulatory regimes of a country, of a nation, around a specific asset, it doesn't matter what you do with the technology, you can't instantly provide access. So, for example, with the wholesale financial markets, you can't sell regulated financial securities to retail investors, regardless of what technology is underpinning those assets, right? And the technology is not really going to change that. It's the regulation, the governance, the risk management, and intermediation fundamentally can bridge some degree of exposure, but not direct ownership in the sense that we would expect the technology to instantly enable.
Right. Well, obviously, if regulation changes or regulatory framework changes, it's going to be new challenges. But let me give you a counter example of something we did at Nexo together with Paxos, like when they issued Paxos Gold, which is an ERC20 token representing physical gold, which is in a vault in London, right? This was phenomenal to me. I've been a gold bug for quite a while. I think a lot of people in the blockchain space have been gold bugs. And it's right now you can buy $1,000 worth of tokenized gold, and you can borrow against it. And this is phenomenal because, like, you borrow, you access your physical gold, and you can buy more gold, go on a holiday or whatever. And up to very recently, this was limited to the ultra wealthy, those with the private bank accounts in Switzerland, and the Credit Suisses and the UBSs. It's only them who could do it. And now out of this simple product, we have liberalized this concept for just about anyone, and nobody would argue that owning an ERC20 token right now is, you're prohibited from that.
I think there's another thing maybe we haven't touched on, which in terms of going back to this piece around liquidity of assets, right? Like, I think of it in terms of wrappers. I think security tokens are the next iteration and the next evolution of wrapper, right? Closed-end funds, mutual funds, ETFs, I think tokens, right? So you get, as you go from wrapper to wrapper, if you think about the history of financial products, you get what we incorrectly call increased liquidity, but really you're getting increased participation from user groups, right? So with gold as an example, right? Investors and institutions, or ETFs in general, right? They all come together and they play in the same space. That's what's interesting about it, and that increases what we call the liquidity. I think tokenization, if you can translate these to a global world and you get away from a place of a US listed product and a UK listed product and a Swiss listed product where you have pockets of liquidity in each, and you can trade one product on a global basis with investors in Asia and investors in the US, then you could potentially see what I call an increase in potential liquidity. Now, I think we use the term incorrectly, right? We have, there's probably 3 or 4 liquidity, what we call liquidity providers in digital assets even here, right? I see a lot of the ETF firms like Jane and Flow, they're all here. They used to trade, they provide liquidity in ETFs. They've moved into the digital sphere. They're building those businesses, right? Now, we call them liquidity providers, but they would probably, and I don't want to put words in their mouths, but they would be the first to say, I think, we don't provide liquidity. We facilitate transactions, right? Liquidity actually comes from the client base itself, right? So you can tokenize anything, right? Unless you've got demand on the other side, you're not adding liquidity, you're adding fractionality or whatever you think it's called.
Which at the end of the day, again, with this metaphor of mutual funds, ETFs, tokens, I mean, it reminds me of the logic of vinyl to CDs to streaming, right? So vinyl can be mutual funds, and actually, I mean, I'm not 100% in your field saying, okay, ETFs have made obsolete mutual funds. There are asset classes for which a daily liquidity is more than enough. No, I mean, private equity per se has an intrinsic investment cycle that doesn't lend itself to an ETF, right?
Maybe.
This is my personal opinion.
I think we can ETFize everything, so private equity included.
Okay.
And I think if you're in a hedge fund space right now, that's sort of a long, slow decline.
Then it's going to backfire on the process of allocating capital through a private equity logic. Because if you don't accept the logic of the J-curve of the period of deployment of capital, you are taking upfront the fact of going to invest. So it's going to change the way you are investing. So Correct. It's going to be another asset class at a certain point, right? And it's the same with tokenization. So some of us might still like the good old vinyl discs, right? Some of us will prefer hearing streaming, which is the real difference that we are bringing through tokenization. It's not necessarily the ability to use it, the usability, it's the traceability. This is something that ETFs do not have, that mutual funds do not have, in terms of way to avoid what I would call the contagion risk coming from a single piece of your portfolio, right? Through blockchain, you can avoid that. And this is something completely new. This is something that can create new pools of liquidity because it enhances the trust that is available. You can do other things through blockchain. You can do pre-IPOs, okay? You can, as we did with the World Chess Organization and London Stock Exchange, based on Algorand, the World Chess Organization, which is a global, very reputable organization, is decided to go IPO'd in the junior segment of the market throughout the year. They are issuing a token on Algorand in order to have a better price discovery, to have, for a piece, of course, that is going to be convertible at a certain point, most probably in part of the equity. It's something that allows a traceability of all the process in a period that is even prior to the admission to the market. And these are the new things that are available with streaming compared to good old vinyl or CDs. Right?
All right, we're wrapping up time here, and I want to actually end on a question. So all these things that we're talking about, right, there needs to be underlying consumer demand for whatever the value is, right, of what's in this new wrapper. What we're talking about is creating a new wrapper that allows investors to access value in a new way that they haven't before. This doesn't really sound like crypto companies. This sounds like traditional finance. So there's this one idea that tokenization is going to democratize access to traditional finance, but you could probably take the other view that actually this is right in the home court of banks and brokerages and asset managers. So if you had to fall on one or other side of the debate, where would each of you fall? And we've got 2 minutes left, so 30 seconds.
30 seconds each?
30 seconds each.
I think that the lines between banks, traditional finance, blockchain, fintech, crypto fintech are getting blurred, and it's all going to converge into one thing, and it's, the regulatory framework will set out how exactly it's going to work, to look like, but I mean, there's not going to be a bank 10 years from now that is not heavily relying on blockchain infrastructure and technology. And also, like the fintech companies, blockchain companies, they're going to get more institutionalized, even only because of regulation.
Yeah, I would say that I think definitely digital assets provide significant value to the kind of wholesale institutional finance and the traditional banking sphere. I think there will be a large-scale evolution in terms of the various roles that participants play within that ecosystem. I think on the other side, we'll see some maturation of the crypto markets through instrumentation of market surveillance tools and some of the crypto exchanges and execution venues, and through other kind of regulatory regimes that form around certain taxonomies of crypto assets that may fall under the remit of a regulator who sees the kind of scale and proportional risk of that market as it grows to be material. But other than that, I think there'll be a large swathe of digital assets that are mostly intangible, that generate growth and demand and scale, and they will continue to grow and proliferate and provide value, wholly orthogonal to financial markets.
So finance or crypto?
You, finance or crypto?
Finance. Got us on the line.
All right.
Well, from my side, I think that actually, yes, the convergence is going to happen, and it's going to happen through the regulation, because the revolution needs rules, as someone said at a certain point in life, and therefore, it's going to be one single thing. You cannot distinguish the protocol from the asset.
So I built, or I'm building my next iteration of my company as a convergence play, right? I think there's a convergence between traditional and new finance. I'll give you an example just to think about it this way, right? In 2009, we invested in Betterment's Series A and Series B rounds, right? Betterment at the time was like one of the first, maybe Wealthfront was just starting as well. They were independent robo-advisors, right? Today, if you own either a bank or an asset manager without robo-advice as a service, you've completely missed the game, right? And a standalone robo is almost, it loses value every day, right? So I think that happens here as well. This convergence, it's early, right? Which is why we have a tremendous amount of independence filling the room, but they become services of the big infrastructure over time.
All right. Thank you very much, gentlemen. That's all the time we have.
Thank you.
Thank you for listening. All right.